Are you a new nurse, a new physician, PA, nurse practitioner, and this is your first time making money? Well, hello again and welcome back to my channel. I am Dr. Brittany Helford, internal medicine physician and wealth coach. And today on this video, we are going to talk about your financial strategy for 2024 as a new high income earner. Now, if you're a resident physician, you might be thinking that you're not really a high income earner yet. And yet is the operative word. But wherever you fall, these tips will help you to achieve financial success in your first job. And I want to say congratulations, because going to school, studying hard, taking your exams is not easy, and caring for patients is not easy. I've been doing this for 8 years as an attending, plus all of my training. I'm well acquainted with the challenges of patient care, but it is joyful. And so I just want you to not have the stress of your finances as you enter into this new role. And I would say probably one of the most critical steps that you can take is to have an emergency fund. And that is because they are a critical component of your financial success. As a money coach, when I speak with women who have debt, whether it's $1,000 of debt or $300,000 of debt, what I hear time and time again is that life circumstances got the best of them. So the first step in order to achieve and maintain financial success is to have an emergency savings. Now you might say, how much do I need? And I think how much you need in this emergency fund really depends on you. It depends on your financial profile. How much risk is in that profile? How many individuals are depending on you? So let me give you a few examples of various financial profiles and how much they might want in their emergency savings. The first is a new resident. You just graduated from medical school and yeah, you got some student loan debt, but you don't have any type of consumer debt. You don't have any children. Your parents are doing well for themselves and they are able to support you if something were to come up. If that is the case, then you likely need $2,500 in your emergency savings. Now you may be thinking, hold up, Dr. Brittany, because I follow Dave Ramsey and he has talked about $1,000. Yes, $1,000 was the documented amount, but we know that with inflation, the cost of things has risen. And studies have shown that $2,500 now is the amount that a person needs in order to afford any emergency that may arise. So my recommendation to you would be, with the first couple of checks, you put away money, that $2,500, into a high yield savings account. And the reason to put it in a high yield savings account is because it will help you to earn a little bit of interest. As a mother of two and as a dual physician household, we have a lot more emergency savings. And because we have those emergency savings in a high yield savings account, it helps us to protect our money from inflation. High yield savings accounts right now are about 4%. We know that inflation has been high, 7%, and the feds are trying to get it down to that 2% rate. So if you put it just in a brick and mortar bank account and it earns 0.1%, you're not going to protect yourself or even keep up with inflation. So those savings, that amount, is not going to help you if you have future emergencies, because the cost of things are just going to rise and the amount that you have placed in an account is not rising at that same level, right? So we want to try to find some sense of parity in inflation and the amount that we will gain or earn on the money that we have saved. Okay, so that's the first scenario. It's basically a person who's transitioning. They have some support that they can call on if they have a major emergency, but they don't have anyone who is relying on them, so they have no dependents. Okay, so $2,500 if you fit that profile. Another profile could be someone like me. I am a woman who's married, but I also have 2 children who are depending on me. So we need a lot more money in our emergency savings, but I don't have any consumer debt. I don't have any student loan debt. So putting 3 to 6 months away would be ideal for me. Now, if you're transitioning and this is your first job, you might actually have some children. And if you have children and you don't have debt, then I would hope that you could start to save some of your money to at least get you to 1 month's savings as quickly as possible. Now, after you achieve that first month, and that's going to be all of your essential needs, right? It's not going to be the amount that you need to get your hair done, right? Or the amount that you might need to buy your kids some new shoes, right? This is the essential savings, the rent, the food, and your bare minimum grocery budget that you need to maintain your health, and your safety. So you want to strive for 1 month at least in that emergency savings when you're just getting started. And then thereafter, you can start to put away additional funds to build it up to that 3 and that 6 months and do that over time. Now, if you're someone who's kind of in between, you're new in your job, you don't have any dependents, but you have some consumer debt, then what I would recommend for you is to strive for that minimum balance of $2,500 so that you can put the rest of the additional funds that you might have, that remaining cash flow, and direct that towards your debt. But if you have a dependent, then you're likely going to need more than $2,500. So if you have a dependent and you have some credit card debt, not necessarily student loan debt because that's a lower interest debt and we're going to talk about that, but if you have high interest debt and consumer debt, which is credit card debt right now is about 18 to 24%, and that is just going to break you. The compounding interest is going to accumulate so fast that you're not going to be able to catch up. So you have to find a balance between having the $2,500 and having that 1 month. Take a look and track your expenses. What do you need for your rent? And how much support do you have? If you have some familial support, I would say do the $2,500 savings plus your rent and build that up in your emergency fund while you're paying the minimums on your credit card. And once you reach that amount, then start to create a debt strategy. So that's it for first step. The first thing that you need to do in order to have financial success as you transition into your first job. All right, step number 2 is to create a debt strategy. And when we're talking about creating a debt strategy, we're going to approach this from 2 particular domains. The first domain is the consumer debt. And the reason why we want to have a strategy for your consumer debt is, as I mentioned, it is a high interest debt. It is going to outpace any gains that you might have in investments, any gains that you might have by putting your money into a savings account, right? So we want to be able to aggressively address your debt. And if you are a woman in healthcare and you're like overwhelmed with debt, you don't know what to do, you need some confidence, a strategy, then I actually have a program for you. It is called my Joyfully Free Accelerator, and I will take you from that position of feeling overwhelmed to having a debt strategy and a plan that you know where every single dollar will go until your debt is paid off. It provides great relief when you know that you have a strategy and you're working that plan. And guess what? The best part about this program is that it allows you to have those moments of joy, because I don't believe that you should attack your debt so aggressively that you're living a life of drudgery. I mean, why go to work if the only thing that you're doing is paying off your debt, right? So I will teach you in this program how to do both. So if you are a woman who has consumer debt and you're feeling overwhelmed without a strategy, then you definitely want to check out my description and the program Joyfully Free Accelerator. And if your employer provides any continuing medical education funding, then you can likely use that funding to pay for this program and get it subsidized, because we know that our financial wellness impacts how we care for our patients. It impacts our physical well-being, our spiritual well-being, our emotional well-being, and we carry all of that into the job, right? So if we want to do the best job, then we got to care for ourselves from a holistic approach. And addressing your debt and paying off your debt and focusing on your finances is one of the ways to do so. All right, so when you're creating a debt strategy, you have to get acquainted with your debt. This is whether you have consumer debt or you have student loan debt. You gotta know your numbers. Look at your interest rates. What are your credit cards? What are the fees, the interest fees that are being applied every single month to that credit card balance? If you have student loans, what repayment plan are you in? What type of loans do you have? Are they consolidated? Are they private? Are they federal student loans? Wherever you are, when you're creating this debt strategy, you have to have the information. And I know it can be overwhelming sometimes to take a look at it, because if you have credit card debt and you've been trying to pay it off, but you haven't made any movement forward, then that might feel defeating. If you look at your student loans and you're like, oh my gosh, I got $200,000 in student loans, then you probably feel a little overwhelmed, because I did when I looked at my student loans. But trust me, if you want to alleviate that sentiment of overwhelm, you got to get acquainted with your numbers and you have to create a debt strategy. You can't fix a problem when you don't even understand the problem. So the second step in ensuring financial success as you transition is to create a debt strategy. And if you have consumer debt or student loan debt, then my Joyfully Free Accelerator program will help you to do that. Now, if you have student loan debt, then there can be a couple of approaches here, depending if you have private student loans or if you have federal student loans. If you have student loans and you just transitioned from nursing school, from medical school, PA school, etc., and you were not working while you were in school, then you likely will be making a lot more in this new role than you have in the past. So what you should do for your student loans, because the name of the game is paying the least amount over time, right, is to keep your student loans in that federal student loans, and then you want to provide them with your tax return from the years in which you were a student. Because if you're making $0, then guess what? Your payments will also be $0. Even though you're moving into this new role and you'll be making a salary, you want to provide the documentation that will help you to get the lowest payment. And this is not fraudulent. This is completely legal, right? So file your tax return from when you were a student, even if you have $0, and submit that as the documentation of your income for your student loans. Now, when you transition, you have the 6-month deferment period. You don't want to take that 6 months deferment, especially if your student loan payments will be $0. The reason why is because if you are going for forgiveness, then you would be missing out on those 6 months of payments towards your forgiveness. After you've saved up for your emergencies, you created a strategy for your student loan debt, the next plan will be to create your budget and get consistent with your cash flow. And this is really important that you now know what your minimum payment is for your credit card debt. You now know what your payment will be for your student loans, and you have this emergency fund, whether it's fully funded or you're going to continue to fund it. All of those numbers will go into your budget or your spending plan. So you want to create a budget that encompasses all of your needs, all of your fixed expenses, all of your variable expenses, and to understand and determine what you're going to have left over. Then once you have that amount that is projected, right, after accounting for all of your expenses, you want to observe that that actually occurs on a regular basis. After you've gotten consistent with your cash flow, I want you to think about getting a credit card. And I know you're probably thinking, Brittany, why a credit card? And the reason why is because this is not just any credit card. This is a credit card that allows you to accumulate points that you can leverage for travel and joy and having really nice experiences. When I talk to women about what brings them joy, almost 100% of the time, it is traveling. So this specific credit card will allow you to leverage one of your biggest assets, which will be your housing expenses if you're paying rent. Now, if you own a home, unfortunately, you can't use this credit card. There might be other opportunities to leverage credit card points. But specifically for those who are renting, this particular credit card, which is the BILT credit card, B-I-L-T, will allow you to accumulate points towards travel, flights, and hotels that will help you to be consistent with your budget and leverage a different type of currency to build wealth and joy simultaneously. Now, remember, you've already demonstrated that you can pay your bills on time. So there is no reason for you to carry a balance on this card. You will be responsible, set it up on automatic payment, and just pay your rent. And while you're doing that, you will be accumulating these points that you can use to go on a nice trip and have moments of joy when you have that vacation time. So that is the 5th step that I want you to take if you are someone who is paying rent, if you are someone who has demonstrated that you can pay your bills on time, then to use this credit card to leverage and create moments of joy without adding additional expenses to your budget. And the 6th thing that I want you to do, particularly those who have paid off all of their credit card debt, or any high interest debt that is greater than, I would say, about 7 to 8%. I have another video about this. It's actually 6%, but it depends on where you fall, okay? So I'll give you a little wiggle room for that. So you've paid off all of your high interest debt. You created a strategy for your student loan debt. Now is an opportunity for you to start investing. And I want you to invest in a Roth IRA. And this is particularly for those individuals who earn $160,000 or less. The reason why is because the government creates income thresholds for certain accounts. And if you make over $160,000, then you likely will not be able to contribute directly into this account, and you will need to take the back door. That doesn't mean that you can't leverage it. It just means that you need to take the back door, okay? And so if you are in that demographic in which you are making more than $160,000 and you got to take the back door route, then you're like me. I do this all the time, right? And so I want you to watch this video right here where I explain all of the pros and cons and some of the pitfalls of doing the backdoor Roth IRA so that you can do it successfully. Now, if you're a resident physician or you're just getting started, you're a nurse, and you don't make $160,000 a year, then I want you to make monthly contributions up to the maximum amount into a Roth IRA. So for 2024, the maximum for a Roth IRA is $7,000. So depending on when you're starting this in the year and how much money you have left over each month, then your contribution might change. But if you're able to do this right at the start, you would basically take $7,000, divide that by 12, and that will give you your monthly contribution that you can automate. You've already examined your cash flow, so you should know how much money you have remaining each and every month after you paid off all of your expenses. So you want to contribute that monthly contribution every single month into that account. And I have other videos explaining like the differences between the Roth IRA and some of the mistakes that I made as a resident, so you can watch that video right here. So let's just do a quick recap. To start off, your financial success is to, one, have an emergency fund based upon your risk profile, and we've already talked about that. The second thing that you want to do is to create a strategy for your high consumer debt and then a strategy for your student loan debt. After you really understand those numbers, you want to incorporate those numbers into a budget to create consistent cash flow that you can predict month to month. After you've done that, if you're a renter, get a Built card and set it up on automatic payment, but start accumulating those points that you can leverage and use for travel in the future. And lastly, depending on where you fall from an income threshold, and if it's not 2024 and you're watching this video, just do a quick Google search. What is the income threshold for the Roth IRA in the year that you're watching this video? But for 2024, it's about $160,000. So if you make above that threshold, you have to do the backdoor Roth IRA, and you want to watch this video to learn more about that. But if you don't and you can contribute directly into the account, then you want to make monthly contributions into your Roth IRA. And if you have money left over and you want to invest more, consider using a 401k. And I have another video explaining the differences between 401ks and IRAs right here. All right, so I just want to say thank you for watching this video. Please make sure that you share it with another woman in healthcare, because it is possible for all of us to achieve financial success, and I want to continue to help you to do so. So if you have a question, a burning question, drop it in the comments. I love to get the questions from you so that I can create videos that you actually want instead of the things that I want to teach you. All right, thank you so much for subscribing and hitting that like button and watching this video, and I will see you in the next one. Bye-bye.